For years, the global silver market has operated under a quiet but powerful assumption that silver is abundant, flexible, and fundamentally cheap. That assumption shaped pricing models, hedging strategies, industrial procurement, and speculative positioning across the financial system. It was rarely questioned because it did not need to be, until it did. Silver's recent behavior has not invalidated this assumption outright. What it has done is more subtle and more important. It has exposed the limits of how far that assumption can be stretched before it begins to distort market signals. Markets rely on assumptions to function efficiently. They simplify complexity. They allow participants to act without constantly re-evaluating first principles. But when conditions change faster than those assumptions can adjust, price becomes the messenger. The shift we are observing in silver is not about excitement or momentum. It is about friction. Price is encountering resistance not from enthusiasm, but from structure. And when structure pushes back, markets tend to misinterpret the signal, at least initially. The prevailing narrative still treats silver as a secondary asset, a byproduct metal, a commodity that responds after others have moved. That narrative made sense when supply chains were elastic, inventories were comfortably assumed, and paper markets could intermediate without hesitation. What is changing now is not demand in isolation, but confidence in how easily the system can absorb that demand. This is why the term cheap silver deserves scrutiny. Cheap relative to what? Cheap under which assumptions? Cheap only exists when availability is taken for granted and when time is not a constraint. When either of those conditions weakens, price must do more of the work. The market has not fully acknowledged this shift yet. Most commentary remains anchored to familiar explanations, macro themes, speculative flows, sentiment cycles. These frameworks are not wrong, but they are incomplete. They describe movement without explaining tension. The tension lies between paper flexibility and physical reality. Silver's pricing structure allows large nominal exposure to exist without immediate physical settlement. This abstraction works efficiently until confidence narrows. When participants begin to question how readily physical silver can be accessed, moved, or replaced, the abstraction becomes less comfortable. That discomfort does not produce headlines. It produces hesitation. Liquidity becomes selective. Inventory assumptions are quietly revised. Risk is carried more cautiously. These changes do not announce the end of an era. They signal that the old framework is under strain. The cheap silver assumption is not breaking because silver has become scarce overnight. It is breaking because the margin for error has narrowed. The system has less tolerance for being wrong about availability, timing, and substitution. This matters because markets do not need a shortage to reprice. They only need uncertainty about whether the next unit will be as easy to source as the last. For professionals, academics, and researchers, this is the moment where attention should sharpen. Not because a conclusion has been reached, but because an assumption has been challenged. Markets can ignore challenged assumptions for a time. They cannot ignore them indefinitely. If this kind of structural analysis aligns with how you track markets, consider subscribing. This channel focuses on the signals beneath price, not the noise around it. To understand why the market is not yet ready for what this shift implies, we need to examine how the cheap silver framework was built and why it is now being tested by forces it was never designed to absorb. The idea that silver is structurally cheap did not emerge from neglect. It was built deliberately over decades through a combination of market design, supply assumptions, and financial abstraction that worked remarkably well until conditions began to change. At the core of this framework was confidence in flexibility. Silver production was treated as responsive enough, inventories as accessible enough, and substitution as feasible enough to prevent sustained constraint. Much of silver's supply arrives as a byproduct of other mining activity, which reinforced the belief that additional metal would appear as needed, regardless of silver's own price signals. Paper markets amplified this confidence. Futures and derivatives allowed price discovery to occur at scale, with minimal friction and limited engagement with physical settlement. Exposure could be adjusted rapidly, hedged continuously, and rolled forward without challenging the underlying assumption that physical silver remained readily available if required. This system rewarded efficiency. It kept volatility contained and allowed silver to be priced as a secondary input rather than a strategic one. As long as demand growth was gradual and supply chains remained stable, the framework held. But frameworks are only as strong as the conditions they assume. Over time, several pressures began to accumulate. Industrial demand became less discretionary. Silver's role in electronics, energy infrastructure, and advanced manufacturing increased its importance in processes that cannot easily pause or substitute. At the same time, supply growth slowed, not because of scarcity in the geological sense, but because capacity expansion requires time, capital, and sustained price signals. None of this forced immediate repricing. Markets can absorb gradual change without adjusting assumptions. The problem arises when multiple slow-moving pressures converge with changes in financial conditions. That convergence is what we are seeing now. The cheap silver framework assumes that time is available, that supply responses can catch up, and that inventories can smooth transitions. When confidence in time weakens, the framework becomes brittle. Price must then reflect not just equilibrium, but risk. Another critical component of the framework was the separation between price and procurement. Large consumers of silver planned years ahead, often insulating themselves from short-term price volatility. This planning reduced visible sensitivity to market signals, reinforcing the belief that demand would always adjust smoothly. What has changed is not planning discipline, but margin. When procurement operates with tighter buffers, the tolerance for disruption declines. Small delays or uncertainties carry more weight. This shifts behavior before it shows up in aggregate data. The market has been slow to recognize this shift because it challenges long-held beliefs. Cheapness was not just a price level, it was a structural assumption embedded in models and strategies. Questioning it requires reevaluating how silver is treated within broader portfolios and supply chains. This is why the market appears unprepared. It is not that participants lack information. It is that the framework through which that information is interpreted has not yet been updated. To understand how this lag manifests and why it can persist even as prices move, we need to examine how paper markets respond when a framework begins to strain, and why their signals can be misleading during periods of transition. One reason the market appears unprepared for this shift is that paper pricing mechanisms are designed to preserve continuity. They are exceptionally good at absorbing stress without forcing immediate structural change. That strength, in transitional periods, can become a weakness. Paper-silver markets translate risk into price efficiently, but they do so by compressing complexity. They treat availability as probabilistic, settlement as optional, and substitution as feasible. As long as these probabilities remain high, the system functions smoothly, even when underlying conditions begin to tighten. This is how outdated assumptions survive longer than they should. When the cheap silver framework began to strain, paper markets did not immediately challenge it. Instead, they buffered it. Volatility was absorbed through positioning adjustments. Risk was redistributed through derivatives. Price movements were framed as speculative rather than structural. This buffering effect creates a lag between reality and recognition. Physical pressures can build quietly while paper prices continue to reflect a world that no longer exists in the same way. During this lag, the market sends mixed signals. Prices move, but not decisively enough to force reevaluation. Liquidity remains present, but becomes more selective. Inventory data fluctuates without producing clear conclusions. Each signal, taken alone, appears manageable. Together, they point to transition. The danger is misinterpretation. When paper markets keep functioning, Participants assume the framework remains intact. They treat unusual behavior as noise rather than information. The system appears stable, even as its margin for error narrows. Silver is particularly vulnerable to this dynamic because of the scale difference between paper exposure and physical reality. The paper market can expand or contract quickly. The physical market cannot. As long as confidence in conversion remains high, this mismatch is tolerated. When confidence weakens, the mismatch becomes visible. This is where the cheap silver assumption quietly begins to fail. Paper pricing continues to suggest flexibility. Physical behavior begins to suggest constraint. The market resolves this tension not by choosing a side, but by deferring judgment. That deferral is what creates vulnerability. It allows positions and strategies built on old assumptions to persist into an environment that no longer fully supports them. For professionals and researchers, this phase is critical because it precedes recognition. It is the period when structural shifts are easiest to miss and hardest to model. Price alone does not tell the story. Behavior does. Look at how exposure is managed. Look at how quickly liquidity withdraws under pressure. Look at which signals are treated as decisive and which are dismissed. These choices reveal whether the market still trusts its framework. At present, the evidence suggests hesitation. The system is functioning, but cautiously. Paper markets are still doing their job, but with increasing reliance on confidence rather than certainty. That is not a sustainable equilibrium. Eventually, the market must reconcile paper abstraction with physical conditions. It can do so gradually through repricing and adaptation, or abruptly through forced adjustment. Which path it takes depends on how long it can maintain the illusion that old assumptions still apply. To understand how this reconciliation begins and why it often accelerates unexpectedly, we need to examine what happens when confidence, rather than price, becomes the binding constraint across the system. As long as markets believe that flexibility remains intact, they can tolerate a surprising amount of strain. Prices may fluctuate, inventories may tighten, and narratives may fray, but confidence holds the system together. The moment confidence becomes conditional, however, the rules change. This is where the silver market now finds itself. The cheap silver framework depended not just on supply assumptions, but on confidence that those assumptions would remain valid under stress. Confidence that inventories could be mobilized. Confidence that hedging channels would function smoothly. Confidence that physical access would never become a binding concern. When that confidence narrows, behavior changes before prices do. Participants begin to act defensively, not because they foresee a breakdown, but because the cost of being wrong has increased. Liquidity providers become more selective about when and how they deploy balance sheet. Large consumers and intermediaries focus more on continuity than optimization. Exposure is managed with tighter tolerances. These shifts are quiet. They do not produce headlines, but they alter the market's internal rhythm. In this environment, price becomes less about equilibrium and more about insurance. It reflects not just what silver is worth under normal conditions, but what it might be worth if assumptions fail. This is why markets can reprice even in the absence of visible shortages or dramatic demand spikes. Silver's structure magnifies this effect. Its physical market is relatively small, its supply response is slow, and its role in essential industrial processes limits elasticity. When confidence in abstraction weakens, price must compensate for uncertainty. This does not mean the market has reached a conclusion. It means it is reassessing risk. Importantly, confidence does not collapse all at once. It degrades selectively. Some participants remain comfortable, others pull back. The result is uneven liquidity and episodic volatility. Prices may stabilize for periods, giving the impression that the adjustment is complete, even as underlying caution persists. This selective confidence explains why markets can feel simultaneously calm and fragile. Calm because trading continues. Fragile because tolerance has narrowed. For analysts focused solely on price, this phase is confusing. Movements appear inconsistent. Follow-through is limited. Reversals occur without obvious triggers. But from a structural perspective, the behavior is coherent. The system is probing its own limits. Silver's recent repricing fits this pattern. It did not resolve uncertainty, it exposed it. And exposure changes how markets respond to the next piece of information, however small. This is why the market appears unready, not because it lacks data, but because it has not yet recalibrated how much confidence it is willing to place in the old framework. To understand how this process ultimately resolves, and what determines whether the cheap silver assumption fades quietly or breaks decisively, we need to examine the final stage of adjustment, where behavior forces recognition. The end of a market assumption rarely arrives with a single event. It unfolds through accumulation. Small signals persist, confidence narrows incrementally, behavior adjusts quietly, and then, often in hindsight, it becomes clear that the framework has already changed. This is the phase silver is approaching. The cheap silver assumption is not collapsing because silver has suddenly become scarce. It is eroding because the conditions that supported that assumption no longer align as cleanly as they once did. Availability is slower. Supply response is constrained by time and capital. Industrial demand is less discretionary, and paper abstraction relies increasingly on confidence rather than certainty. When those elements drift out of alignment, markets do not need a dramatic trigger to reprice. They need recognition. Recognition does not begin with consensus. It begins with behavior. Participants shorten time horizons. They value access over optionality. They pay closer attention to physical signals that were previously treated as secondary. None of this requires panic. It requires prudence. This is why the market appears unprepared. Many strategies, models, and narratives are still anchored to the old framework. They assume that price volatility is cyclical, that supply will respond, and that equilibrium will reassert itself without friction. Those assumptions may still prove partially correct, but they are no longer sufficient on their own. The deeper implication is not that silver must move in one direction or another. It is that silver may no longer be priced as a residual input. It may need to be priced as a strategic one, where timing, access, and reliability carry more weight than they did before. This shift does not happen overnight. It happens as markets learn where the new constraints lie. It happens as participants adjust to operating with less margin for error. It happens as confidence is rebuilt under different terms. If confidence returns unconditionally, the cheap silver assumption may fade quietly, replaced by a new equilibrium that still allows flexibility. If confidence remains conditional, the assumption will give way more visibly, as price continues to do the work that models cannot. For professionals, academics, and researchers, the significance of this moment lies in what it reveals about the system's adaptability. Markets are not failing when assumptions are challenged. They are evolving. Silver is simply highlighting the cost of relying too heavily on abstraction in a world where physical constraints matter again. Whether this episode is remembered as a turning point or a transition will depend on what follows, not in price, but in behavior. Watch how quickly markets respond to new information. Watch how readily liquidity appears under stress. Watch which signals are treated as decisive. Because when an assumption finally gives way, it is not the price that changes first. It is the way the market listens. If this analysis added clarity beyond the usual headlines, consider sharing it with others who study markets through structure rather than sentiment. And if you're observing similar assumption shifts elsewhere, in energy, credit, or currencies, add your perspective in the comments. Markets do not announce when frameworks expire. They simply stop behaving as if they still apply.